Target date retirement funds. The easy button for investing in your 401k, right? But they're not all created equal. Cost, performance, and safety vary widely, especially in the crucial years right around retirement. Today we discuss what they are, how they work, the criticisms, the defenses, and how to make sure you're getting what you thought you were getting. All that and more right now on the Retirement Lifestyle Show.
Welcome to the Retirement Lifestyle Show. I'm your co-host, Roshan Loungani, here as always with Adrian Nicholson and Erik Olson. Gentlemen, we have another good week. I'm sorry I missed last week's episode, but I'm looking forward to being back.
Man, Roshan, it was killer. You missed out big time. Adrian and I, we got lit, right? Adrian, I mean, it was just amazing. The Dorito bags were flying. It was amazing.
Well, I'll agree with.
Sorry,
Erik.
That's a shout out to our friend Jill.
I'll agree with Erik. It was another solid episode. We livened up the bond and inflation talk, so it was an overall solid episode. But my favorite episode is when the crew is all together, the squad's back together. So I'm really happy and I'm looking forward to another episode.
Yeah.
That's great. Hey, by the way, Roshan, I want to say in person what I said on the podcast last week, which was when you weren't here, thank you so much for the high impact life segment on that episode that you did without me when I was in Nashville for the podcast movement conference. I'm driving along and Joni is in the seat next to me sleeping. So I got my earphones in. I'm listening to the episode. And Adrian starts talking about the Special Olympics and, started organizing all that. I said, this is awesome. So thank you so much for doing that.
I can't claim any credit for that at all. That was all Adrian. So Adrian, that was definitely a great addition.
Okay, Adrian.
I was just trying to figure out a way to get Erik on the podcast, even if he wasn't here, just trying to bring us all together whatever way I can. So I'm glad it worked out. I'm glad you enjoyed the content, Erik. And I'm sure the listeners are enjoying another lively discussion today. Yeah, I'm ready to get into it.
Yeah, so today we have a really interesting topic that I feel like affects almost anyone that has a retirement plan. Retirement plans, and by retirement plan, I'm not talking about a financial plan. I'm referring to a 401k at work, a 403b, a TSP, any retirement plan through your employer. They all now tend to have these target date funds. And what a target date fund is, it's a fund that's set up where you want to line up the target date theoretically for when you're going to retire or around it, because it's not every year. They're usually on 5-year increments. And then you go ahead and invest in that. And in theory, what it's supposed to do is take the guesswork out of it for you and have you set. You can put your money in this thing and not worry about it in theory. Well, today we're going to talk a little bit more in depth about these target date plans, the positives and negatives, how they work, some of our advice to you, the listener, on whether they have a place in your portfolio or not. So we're going to go over all of that. And the reason I think this is so important is because the fact that they're available now and they're under the sort of the guise of being easy, you're just getting a lot more use of it. And I think it's very important for you to know whether it should be a part of your portfolio. So, gentlemen, anything to add on why this is important? And, oh, by the way, for our listeners, what I want to share with you is we've got a format today because we think we have too much content and could be on here for 3 or 4 hours. We don't want to keep you here that long.
No.
So what we're going to do is review why it's important, what the critics say, what the defenders say, the glide path on how it works, and then give you a little bit of our advice on this. So I have volunteered to moderate today to keep us moving because we just feel like we'll have way too much and go way over time. So you'll notice I'm going to play a little bit of that role today. So as we go through the first section of why it's important and defining what they are, gentlemen, is there anything you'd like to add on the definition I've shared or why it's important?
Adrian?
I think the thing I found most interesting, or that came up a lot, and you kind of addressed it, Roshan, is this is kind of like an autopilot investment, and they're widely available if you have like a 401k or like basically anything like you said, Roshan, that people are being exposed to this, and there's a lot of them out there, and that the autopilot feature on this investment is something where people can kind of set it and forget it. Where this episode, we're going to kind of address both sides to the target date fund. What are the pros? What are the cons? So kind of give you an overall view of it. So if this is something that you're invested in, you can kind of get a good overview and a good sense of what you should do moving forward.
Yeah. Erik, anything to add on that section?
I don't have anything more in terms of the importance, except, I think you've said it. So I'd like to, if you're ready to dive in and talk about some of bring this thing.
So Adrian, when you starting with our first section of some of the criticisms of these funds, Adrian, what did you find? Yes.
Well, before you get to criticisms, let's actually detail a little bit more about some of the differences.
Yep.
All right, we'll get to the criticism in just a second. So for those of you who are listening and you have one of these, you'll recognize the names. That'll be target date something, 2030, let's say 2025, or you'll see life cycle fund, or you'll see some other sort of name for this sort of fund. What it's designed to do is to bring you into, as the years progress and you get closer to or past that retirement date, that it'll adjust the allocation for you. And so on that basis, you're not stuck with the same allocation, a year or two before you're retiring as you had 15 years before you were retiring. But these funds are not created equal. And the differences include some of the following. The first is that they have dramatically different expenses in some cases. So I would encourage you to get acquainted with the underlying expenses of the funds in your plan. For example, one of the funds that's Morningstar tracks in this category has an annual expense ratio of 1.77%. So in other words, you're taking out nearly 2% per year to run that fund. At the other extreme, there are some that are as low as 0.08%. So basically 1.7% less expensive than at the other extreme. So the cost can be an issue.
Well, hold on, Erik. On that cost issue, it's worth noting sometimes what you're paying. There's a report called the Statement of Additional Information. If you really want to know the cost that you're paying for your investment, you've got to look at that, because in addition to the management fees, there are other costs that could be, as they could call them, administrative, or they could be trading costs. So if you have a fund with high turnover, in addition to management fees, you're going to have higher trading costs, and you need that statement of additional information to figure it out. With target date funds specifically, they're typically funds of funds. What that means is you put your money into one fund, it's then split into a variety of other funds. Now, to have them select those funds, you may be paying what a lot of companies will call their capital markets team to decide that allocation. So you pay a fee at that point, and then when it goes to those funds, you may be paying another fee. So, Erik, when you reference those fees, this is what you're paying for at those different levels. And this was definitely, when I was going over the criticisms, one of the items I had in there as well is just, you said it really well when you said they are not all the same. And that may actually be the understatement of the episode, that they're not all the same, right?
All right. Yeah. Well, that's true. So let's hold off on the criticisms,
well, wouldn't you say
because I do want to come to that in just a second. But I'll defend some of the costs. I'm not to defend all of them. So on the one hand, if you're in a really small plan, but you have some advisor who's actually coming in and providing education and helping the management team of your company with this, absorbing all of this process, and the management team of your company doesn't want to accept any expenses on their side related to the management of the plan, and they don't want to push explicit expenses that are line itemed onto your own 401k quarterly statement, they'll build those expenses right into this fund, and they'll select funds, in fact, that pay all of those other costs and absorb them within the expense ratio. On the other hand, if you're with a really large firm, or you're with a firm that says, no, we as part of our mission to help our employees save, want to absorb all of the costs of the advice that's being provided by the financial advisor and all of the other expenses, then they can select, I should say, funds that have these wafer thin expenses, and then account for or pay for those other costs as separate line items, either at the company level or at the participant level. So I'm not saying that high expenses, all else being equal, are a positive, but I do want to just outline that there are circumstances in which it's, I suppose, defensible that you have some differences in these costs.
You didn't mention this one, but I would also say performance, right? If you're paying a higher cost and you're getting better performance, it's worth it than paying a lower cost and getting worse performance, right? So if you're outperforming that difference in fee significantly, then why not?
Yeah. I'm not going to argue that. So other sorts of things that I think are worth understanding is, and we're going to talk about this in greater detail later in this episode, but it's the notion of a glide path. And I've already explained that, and Adrian has as well addressed that you're essentially over time having the portfolio automatically adjust as you get closer and closer to and then enter into retirement. Presumably you've selected a fund that has a retirement date label that matches up with approximately your own retirement date. But underneath that common description for them of a glide path, it's worth understanding that there are at least 3 different glide paths. We'll get into deeper detail there, but what that results in for you is that the composition of these funds from a risk standpoint can be pretty different, especially as you're in the near dated funds. Now, if we're talking about, somebody who's 25 years old and they're investing in, let's just say, they're investing in the 2060 retirement date fund, there's not going to be the same differences in the composition of those funds. But if you're talking about the 2025 dated funds, you'll have some that Morningstar would assign a risk score that would be considered moderate aggressive. And here we are 4 years from that retirement date, whereas other companies will set something up that Morningstar would describe as moderate conservative and everything in between. So it's worth understanding what is the underlying philosophy that's driving your plans, or the target date fund's composition. And then the third thing I'll mention is a direct byproduct of what I've just said, that in bull markets or bear markets, the performance accordingly will differ substantially, primarily due to those differences in whether it's more aggressive or more conservative. So if you look back and you say, we've had a pretty strong, let's say 5 or 10 year run in the markets. If you look back and you say, wow, my target date retirement fund has been killing it. Or conversely, you say, man, it's been a dog. Well, it's possibly largely explainable not because necessarily they're superstars or total losers at fund selection or stock selection, but instead might simply be that one is very aggressive comparatively and the other is quite conservative.
And actually, when you mentioned the glide path, I found and I'll try to share this link in our show notes, but I found this thing. Now it is a little dated. It's from 2016. It's by State Farm, and they compared the industry high on retirement date versus the industry low of these target date funds. And gentlemen, I'll ask you, we'll play the guessing game. What's the industry high on retirement date? Your target date fund said you're retiring right now. What's the most a fund with that same date will have in equities? What would you guess?
I'm going to say in the neighborhood
Adrian?
of 80%.
I'd go closer to 70%.
So you're both a little bit high. The industry high, and once again, this is as of 2016, but was 64%.
Okay.
Now, conversely, what would you guess the industry low was at the time? The lowest a target date fund would have in equities if you were retiring at that time.
I'd say 20%. I'd go more to 20%.
I'll say about 30.
Adrian says 20. Eric, you said 30. The number was
30.
8.
Wow.
So if you just
Oh, really?
now, as I mentioned, the information's dated, but the point is unchanged. These two funds would have the exact same target date. So let's say you go to your employer, you say, okay, I'm retiring in 2025. You pick the 2025 fund. One of those funds, if your employer just chose that fund, once again, they may not have been intentional at all on their part, but they could have 8 times the equity exposure versus them just picking another fund, right? And a lot of times the people making these fund selections, they're not a lot of times, almost all the time, they're not investment experts. They're just thinking, hey, this will work well for my employees. They're typically HR professionals. And so I just thought that data point, when you mentioned the glide path, it just shows you what a big, and we keep using the term glide path. The glide path is how much the allocation is towards stocks, bonds, and cash for the target date fund as it shifts along the way. But as you mentioned, that glide path and how they can be different, I mean, this to me is wildly different. That 64% versus 8%, and they're categorized as the same by all sources as well. So you got to dig deep into the allocation to determine where the differences lie.
Yeah, it's a really interesting concept, and it's just important to note that people's like needs and goals are always changing. So this kind of set it and forget it, this kind of autopilot sometimes can be sometimes a disadvantage, whether, let's just say, you're choosing to retire early or you're deciding to work longer, where you kind of maybe like set this up in the beginning where you had this like target date in mind, but over time, you know, your needs or your goals or whatever your situation in life may change. So that's something to consider as well. I think is a little bit of a disadvantage sometimes to this.
And Eric, I'm going to get us back to differences, but I'm going to ask you to name them versus describing, or name them, and we'll touch on them very briefly just so we can move on to what we've got as the criticisms of the funds.
Well, I think I've
Excellent.
already identified them. With the possible exception, you know, if we do a deep dive on the performance at some point, but it is, I want to.
You did touch on the performance, and I think this equity difference we just talked about will reference that as well. That, you know, depending on if stocks are doing well and you've got 64% in stocks, that'll perform very differently from the fund with 8% in stocks, and vice versa. If the markets are crashing, the 64 will take a significantly greater decline than the one at 8%. And Adrian, I'm going to let you start off with criticisms. What's the first one you've got on your list?
Well, I think I kind of went over it already. Just the change, people have changing needs and goals. I think that's really big. But also kind of going back on it, you kind of have to peel back the layer a little bit more, where I think you have to kind of look into, let's just say if it's heavily in equities, well, what kind of equities is it? Is it like, what's the objective of it? Does it focus more on domestic or is it more international? That can also be a big thing to really consider when you're just like looking up the makeup of the fund. I think is really important to note as well. And on the other case, if it's like heavily in bonds, are these like high yielding bonds? Are these more whatever it may be? And just seeing, like, I mean, me and Eric had a whole episode on it. Can this even keep pace with inflation? I think that's also another consideration that people have to talk about when it comes to the overall performance of it.
Yep, that is definitely. I just keep going back to this 8% versus 64, because to me that difference is so huge. I don't see how you can be in the same category, but they are. But inflation is a great point there. And you mentioned changing needs. Eric, what else do you have under the critics category?
So I'm not going to do deep dives on these, but just to highlight them. So one criticism is what Adrian just pointed out, is that they're not necessarily terribly diversified. Yeah. So now let me put that comment in context.
That requires more information.
Yeah. So if you're in a fund, if you're in a 401k plan or a 403b plan, and there are 20 or 25 funds that your employer has provided, and none of them, let's say, touch on some of the asset classes that Adrian just cited. Maybe there's no high yield bond, there's no emerging market bond, there's no international bond, there's no small cap, et cetera, then within these funds, oftentimes they'll tap some of those other asset classes that are often ignored. But even then, there tends to be a concentration on things that seem to have been working lately. It's kind of the old story of buy IBM because you'll never get criticized if something goes wrong. If you're the purchasing manager and you're supposed to buy computers for the corporation, you could buy somebody else's, but if you buy IBM, you won't be blamed. I think it's the same. There's a little bit of the same incentive here, is to buy U.S. stocks and buy U.S. bonds. And if something goes awry, you at least in that sense, you bought IBM.
Yeah.
So that's criticism number one, is a slight lack of diversification. I've got more, but if you want to say more about that, let's.
Well, no, I don't know. I guess what I would say to your criticism is, yes, you could say they're following performance in that regard, but this is not the U.S. markets have done better than international markets for how long now? 20 years plus. So I would counter your criticism with criticism of it, just by saying that I see your point, but it's not like you're seeing a major change or a major opportunity extended period of time in those other areas. So I don't know if that is necessarily a bad thing in this case. And when you say lack of diversification, especially with a lot of funds, a lot of these target date funds saying that they're diversified. That's why I wanted more detail on there. It's because a lot of times in our industry as a whole, when people say diversified, they're just saying you've got to split between stocks and bonds. So I think it's very important to make the distinction of, well, what do you have within each of these categories? So I like that you're going deeper in that, but I don't think it'd be a fair criticism to say they're not diversified. It's probably fair to say they're not as diversified as you would like them to be.
That's precisely what I'm saying. So not adequately, they need better diversification. It's not as though they're absent. On top of that, there's the function of these funds that when they're building they're essentially, as you pointed out earlier, fund of funds. So what are the underlying funds? Well, they're entirely funds from that same fund family. And so what they have is this bias toward their own products, and they're channeling funds into their own products. Whereas if you look at a typical 401k plan, you'll at least have some breadth of investment company representation in there. But if you go with the life cycle fund or the target date fund, you are essentially investing all of your dollars into their own product. And in that sense, you have to ask, is that really a truly fiduciary decision for those investors? Or would it be better if you said, we're going to do the best in class in each of the asset classes that we have represented in the fund? So that's a second criticism. And I think for that reason, if there's enough breadth of offerings within the single asset class funds within the 401k, and I'm using, listeners, 401k as sort of a shorthand for all the other sorts of workplace-based retirement plans. But assuming that there are other options there, you may be able to do better if you're an attentive investor to select the best in class that's offered and then assemble essentially a diversified portfolio of your own. So that's a second criticism.
And a couple things to add on there. One is most fund families aren't good at everything, right? Like picking out PIMCO as an example, just because they're known as the bond fund family, right? Because of how they were built. So not necessarily a criticism of them or not, but the fund families that are good at one thing are typically not good at everything in terms of asset class. So you are probably getting a certain area of really good performance because that fund family is great at one area, but you're probably missing out on other areas. The second thing I'll point out is you're not always getting the best performers in those classes for those companies. You may be getting where they may be setting up a new fund and raising capital in it, and not necessarily in a negative way. They may be thinking, hey, this is going to be a great fund, let's add money to it. But you may not make that decision. If you were splitting it up, you might say, I want their best performer, not their new fund that they think will be a good performer. And not all funds, target date funds, necessarily work like that. But the point is very important. If you pick target date fund from company X that's known for this really good fund, you may not be getting that fund in that target date fund.
Right. Yeah. So that's, I think, another one. And then the third I would just say is, and this is connected to the one I was just mentioning about the home product bias, if you will. And that is that because the Pension Protection Act of 2006 instituted this requirement that there be qualified default investment options within default investment options within qualified plans or with workplace-based retirement plans. What's happened is that a lot of people are just being signed up for their 401k. So they're investing in it. They didn't really pick it. They didn't really think about it. It's sort of just going on in the background for them. And these fund companies know that those assets are really, really sticky.
Yeah.
And so I think that takes away some of the discipline for them to be constantly really excellent at what they do in some of those asset classes, as you pointed out, that may not be big categories for them as standalone funds, except within the target dates. So on that level, I would say I think it's periodically useful, particularly if you're listening and you're a business owner, or you're listening and you are an HR director, or you're listening honestly and you're a financial advisor. Then I would say it's as a fiduciary step, you should periodically scrutinize these target date funds that you're using and ask whether or not somebody else's tools might work better for you. Now, I have one last comment about that, but do you want to say more on that?
Well, just the point you make of assets being sticky, essentially people putting their money in that fund and not changing it. I typically will review and look at rebalancing 401ks annually. They may not, I've done a variety of research myself and read many studies that say the optimal period is 18 to 24 months. But I have met many people after they've been at an employer for 20 to 30 years that literally never picked it and never changed it. Right. So when you talk about sticky assets, that just literally I had a few people come to mind that they were specifically government employees where they were defaulted into the G fund, which were the government bond funds. They were there for 20 to 30 years and literally never changed it and have been there for 30 years in government bonds.
Yeah, it's amazing. Well, so I wanted to come back to the fiduciaries.
Yes.
That's the business owner, the HR director, the financial advisor, or what have you. And when you're looking at these, and the advisors should know better, and I think they do. But there's a bit of a motivation on their part to try to look like they're going to be doing a better job for you if they're coming and making a pitch to you about how their ability to pick these funds is superior to the person that you already have operating in that role. But here's what I would say is, coming back to the comment that we made earlier about the big differences that there can be, especially on near dated funds, in the amount that's allocated to equities versus bonds and what have you. Then, and we also said that extends then to big differences in the performance of these funds. If I look at, for example, the trailing 5-year returns on the 2025 fund class, I see some that had a 5-year compounding return in excess of 10% per year. I see others that had 5-year compounding returns below 4% per year. That's a big difference. And if all I did was say, oh, look at your funds are terrible, mine are so much better, there's a built-in incentive in that system to try to promote the funds that have the highest equity concentrations in the aftermath of a bull market. And in the immediate aftermath of a severe bear market, then the opposite is true. So just don't allow your lens for selection to be overly colored by purely the performance question without taking into account or holding constant the question of how its underlying glide path philosophy and hence its composition, because that composition may explain all of the differences between those two outcomes for those investors.
And it's also worth noting that Morningstar stars will weigh towards that as well. So if you go in there and you say, well, I'm comparing these target date funds, this one's got 5 stars, this one's got 1 star, you've got to take into account, well, what's their glide path, and are you coming on the heels of a really strong bull market? Because that's how Morningstar stars will grade the funds. So you think that might, I definitely have met people who thought, well, an easy way is just to look at those star ratings. And that really isn't an easy way to do it. That'll put you in the same direction as the performance as you just explained.
Right. I think there's a built-in. So I'm glad that Morningstar exists. I'm glad that some of these other fund rating systems exist. But I think we do have to acknowledge that there's sort of I would say in some ways, an overly cozy relationship between the rating agencies and then the big fund companies. And essentially the star rating that you just described is essentially incentivizing the companies to go most of the time for bigger risk, which may be appropriate, by the way. That may be a good thing, and you may want that as an investor. I'm not casting judgment on that right now, but judged naively, what that really I think serves to do is to reinforce and drive assets toward those fund companies that have elected to have the riskiest allocations during and if they were rewarded because it was a bull market period, then they come out winners in that phase. And again, because of the stickiness, I think there's a built-in incentive for more fund companies than I'd personally like to see that have committed to the glide path that is on the riskier end of the spectrum.
Yeah, and I just want to make a quick point, kind of stepping in the shoes of our listeners right now, and kind of like the themes and concepts that you brought up, Eric, and you brought up too, Roshan. So it just seems like when people look at target date funds, like the big thing that comes up is like it's a good way to diversify. But kind of what you guys are bringing up, that's sometimes not the case where, some target funds might just be like heavily in equities and some might be in bonds because they have a shorter target date fund. So it would seem that you would have to diversify even more by, let's just say, spreading your capital by taking on these two funds. Like I know it's like similar with bonds. I think it's either called like barbell or laddering, where you'll have like some short-term bonds and some long-term bonds. Is this kind of similar what you would do like if you had like all these like target funds to choose from, like choose one that is in like 2060 and then one that's like right around the corner, and then diversify even more with a target fund that's more into like equities now? I guess it's the same thing where if it's a long time, it's going to be in equities, and a short time more in bonds. So are you kind of like, it's like a give and take relationship as well with risk and performance, where you're just going to have to diversify even more of these target funds where this kind of autopilot feature doesn't really work? Or what's kind of your take on that?
Well, see, a lot of people, if we're speaking of their plans for their employer, they don't have the option to pick a bunch of different fund families, target date funds. Now, they can pick varying dates, but the whole concept of these is that you don't need to pick varying dates. But once again, what we've been talking about, how the glide paths are different with different fund families, it makes a huge difference. So let me explain what I just said a little bit clearer, because I confuse myself with so much there. But what my point is, if you're at an employer, you can't pick a bunch of different target date plans. So you're stuck with the glide path they have chosen. And the glide path they have chosen should then line up to your date if that is right for you. Now, Adrian, if you've then done research and you've said, well, I feel like I need more equities than their glide path has suggested, then you may want to pick a further out target date. But in theory, laddering the target date doesn't necessarily make sense because you're on that same glide path. So you'd more want to figure out what glide path lines up to you and pick that specific fund, which may not line up to your retirement date just because the glide path they have may be more aggressive or more conservative than you'd like.
I think he said what I would have answered, Adrian, so I don't have any further commentary on that.
Excellent. Let's continue on.
So how about defenses?
Yes. Have we? Well, real quick, I just want to make sure, just to state them without going deep into them. The criticisms I had on the list, we've covered all of them. Mine were that all the fund families are different, so you've got to look at that glide path. Two is the management fees may vary. We touched on that at the beginning. Three is the funds in the mix may be the funds that they've chosen may not necessarily be the best in the fund families. And then there were other just deeper glide path management issues. Do you either of you have any other criticisms that we can list and then move on to defenses?
None.
All right, Erik, do you want to start us off? What do you have on the list first for defenses?
Sure. Well, so the most vigorous defenses that I saw of the target date funds, and I'm not. This isn't. I don't mean to say that they're not sincere. I believe they are sincere, but it isn't terribly surprising that it's coming from the number one reviewer of mutual funds, and that is Morningstar. So Morningstar would say, and I'm looking at some responses that were done here in May and in April of this year. And one of them is by John Reckenthaler, and bright guy. He's a very credible fellow. So this is not in any way meant to sort of insinuate that he's saying something that he doesn't truly believe. But his comments are, number one, the recent wave of criticisms are they have some merit, but if you're talking about expenses on these things, on balance, the median expense for let's say a 2035 fund is 0.65% per year, which when you think about all that's being accomplished in that fund is not necessarily is not stealing necessarily from you. I mean, remember, it can be for performing a variety of functions, including compensating an advisor for the advice that's being provided there. So, in fact, his comments is, yes, it is true that these fund companies are selecting from their own stable of underlying funds, but often, not always, but often they're subsidizing these target date retirement funds in order to win business, because they know that part of the fiduciary review process that's occurring in these employers is to look not only at performance, but also to look at cost. And so you, in some cases, may not have a strong performance edge, but you may have enough of a cost advantage that you land another plan that you otherwise would have missed out on. And so that's one of the key defenses. And then Christine Benz, also at Morningstar, in April wrote an essay on this, and she said, well, look, for all those criticisms, let's look at some of the outcomes, not in terms of their design, but their outcomes. So one outcome is that they do allow investors to be hands off. I mean, think about how many people have been able, through the advent of this requirement that there be a default investment option, and that they furthermore have a default contribution, there's an opt-out option rather than an opt-in option. It's actually helping people to save in a somewhat diversified portfolio, even though they may not have particularly strong interest or expertise in the area. And in that sense, because they do have a glide path, whether or not that glide path is optimal, and we'll talk about that in just a moment, but nevertheless, they do have a glide path. And in that sense, you could characterize that as a kind of advice. And so they're delivering a kind of advice about the gradual adjustment of the composition of your portfolio and the rebalancing of your portfolio in a way that many people might not otherwise access, and all again at that median fee of 0.65% for the 2035 fund. So those are the two primary defenses, I think, that she issues for these. It's really outcome-based commentary for Christine Benz.
Well, let me jump in first on their costs. I just want to clarify, not all of them are expensive. You know, like you went through that range. It
Correct.
does vary.
That's right.
And so I would even say that it's what you're getting for that cost is important to note, which the author did state that. So even 0.65, which is their average cost, that's not
Mm-hmm.
bad compared to funds that aren't doing fund to fund work, right?
Correct.
So
I agree
I
with that.
think with the
Mm-hmm.
cost thing, my point when we were going over that was just that they can vary significantly and know what you're getting into. Is it worth it or not?
Mm-hmm.
Her
Mm-hmm.
statement on performance and or let me restate that they make it easy, you know, sort of the diversification and having the portfolio. That was actually the one item I had on my pros list as well. That
Mm-hmm.
that
Mm-hmm.
rather than because there are definitely some people that will join their employer, set it up, stay there for a long time, and never do anything about it. I think it's probably
Mm-hmm.
better than, like I mentioned, the client I had that was in the G Fund and the TSP, the G Fund's government bonds. It's right now returning like, you know, under 2%, maybe slightly over 1, right? And they've had that for 30 years. I think their performance would definitely be better if they had a glide path scenario versus them having just this one G fund over the last few years. What that doesn't necessarily touch on their risk tolerance, but I do think their overall performance would be better if they had the glide path over the years. I think they'd have more money at the end of the day if they had the glide path versus them having just the one fund. So I believe we've covered all of the defenses. The couple things we touched on were, one, it can be easy. Two, it may be a better default than what was chosen previously. And three, though some of them can be expensive as an overall group, they tend to be reasonably priced, and you've just got to figure out what you have. The next thing we wanted to touch on was the glide path. And the glide path, that's the allocation that the target date fund will follow over time. So, Eric, why don't you start us off with
All right.
that section?
So the glide path, again, is how much the allocation to stocks, broadly speaking, whether they're U.S., international, large, small, what have you, and versus bonds and other asset classes shifts gradually away from the high levels of stock concentration that usually would be advisable and present in these when you're someone who's in your 20s and you've got a 35, 40-year savings runway before you might be thinking about retiring versus the person who's on the cusp of retiring. So there's different philosophies about this, as well as the industry pressures that we were talking about before. So I'm going to leave aside for now the industry pressures and instead just talk about the philosophies. So the philosophies are categorized under these three labels. So label number one is to retirement. The second is through retirement. And the third is to and through retirement. What do these mean? The to retirement, or actually, let me start with the through retirement. The through retirement view is by far the dominant view. The largest fund families in this category use and follow, broadly speaking, this approach, which is to say, we're trying to fund a lifetime of withdrawals. And so our best way of accomplishing that for you is to not go too quickly to a lower equity allocation in your portfolio. You need the growth. And so over time, we're going to maintain, yes, gradually, we'll dial it back, maybe to some sort of level where it levels out and it stops dropping any further. But we're going to keep a fairly high concentration of stock as part of your portfolio in that window right around the retirement date, 5 years before, 5 years afterward. Despite the risks that may present, we believe in the long run that's the most advantageous approach for you, because you want lifestyle. This will help you with on the growth side to get that lifestyle. The to school looks at it differently. They say there are other ways of having sufficient assets for your retirement than merely having a high concentration of stocks. Those include saving more, working longer, etc. Their contention is that the risk presented in that 5 years before and 5 years after by a major downturn in the market, such as we had in 2008, or for that matter, such as we had in the immediate aftermath of the internet bubble bursting, or more recently, the last quarter of 2018, or even more recently, the first quarter of 2020, those kinds of declines can be disruptive. And now no one's unaware of the fact that there was a massive rebound coming out of the first quarter of 2020 decline. But that you could say, but what if that didn't happen? Would you have wanted a portfolio that took a big hit in the first quarter if that was really in that very sensitive period for your own retirement? And how might you react to that? The third school will say, so anyway, the two school would say, let's get a lot more conservative starting about 5 years beforehand. Maybe even take it down to the amount of stock that you have in your portfolio is let's say at the 30% level or even lower. And then finally, the to and through portfolio approach or philosophy is really is been influenced by some research we've mentioned on this podcast before. That is by Michael Kitzes and Wade Pfau, who wrote a paper that showed that the conventional thought about the appropriate equity balance of a portfolio is actually mistaken. They would say that their modeling showed over many, many different market environments that the best way to ensure that your portfolio will provide for you over a 30 or 40 year retirement horizon is as you about 5 to 10 years before you enter retirement, that you start dialing it down to about the 30% stock level, give or take 10%, depending on your risk tolerance. But from that point, don't hold it there, gradually raise it over time again. And so you're essentially, in that sense, looking at it's a reaction, you might say, to the to school, which wants to get pretty conservative at the point of transition to retirement and stay conservative. This school would say, no, actually, you're better off if you get back into a larger equity allocation again. So those are the three schools, and I want to talk about them a bit further, but what sorts of reactions, Roshan and Adrian, do you have to that framework?
Well, the first one for me is T. Rowe Price has a slightly different definition. Mm-hmm. T. Rowe Price has a slightly different definition where they say the two funds, they're for investors who expect to spend all of their money by the target date. The through fund are for investors who plan to withdraw the value of their money gradually after retirement. And the reason I've seen similar definitions to what you have as well. The reason I like this one a little bit better is because to me it explains it a little bit better in the sense that it makes no sense in my mind to go all the way that low in risk and equity exposure that the two funds use. And this hasn't make more sense to me. So I want to explain that a little bit further to the listeners. So hypothetically, let's just say you're retiring in 2025. A two fund for 2025 would not be right for you because that's saying you're going to pull all of your money out in 2025. A through fund would mean your retirement starts at 2025 and you're going to begin taking money out then. Conversely, if you were retired, if you're turning 100 in 2025 and you retired 30 years ago, a two fund to 2025 would work for you and a through fund would not. So to me, the most important factor for anyone listening that wants to figure out how they use this for your portfolio is first figure out which glide path scenario the fund available to you is using, and how that lines up with your goals. If you're going to be retired and have all your money out by the target date, a two fund would be right versus a through fund,
So,
and vice versa.
using that definition, Roshan, so let me just make sure I'm following what you said there, because I have not encountered that definition. So when you say you pull all your money out, you're not saying pull it out all at once. That would be the point at which you would anticipate you would not want your portfolio to exhaust prior to that date, but if it exhausted at that date, you'd be fine with it through gradual
so not pulling
withdrawals.
Correct. Yeah, not pull it out all at once, but the two fund, once again, using T. Rowe Price's definition, says that by the time it hits that target date, all or most of your money is out of the fund.
Interesting. Well, so that raises another thought for me, which is, in truth, how do people actually behave with these? With their
and so that's where this definition is so important, right? Most people will retire and take money out gradually, and if you were to pick a fund that uses the glide path to retirement, and you choose the date of that fund that corresponds with your date of retirement, well, you definitely picked wrong then.
Well, here's a slightly different angle. I think the as you defined it, or using the definition of the two approach that you just cited, what I would observe is that it's a bit presumptuous, because it presumes that the participant in that 401k plan is going to keep all of those assets in that fund for the rest of their life and gradually take withdrawals from their 401k. I don't think that's what most people do. I think instead what most people do is they reach a point where they say, okay, I'm going to do a rollover into an IRA. Now, not everyone, but I'm going to do a rollover into an IRA, and then I'll build a portfolio that's right for me at that point, not any longer using retirement date funds. And I would say that's particularly true for higher net worth people. So, and mass affluent and high net worth people. So on that basis, I think it's if the way that's built is that it's essentially saying, we're going to get you to age 90 or 95 or 100 or whatever assumption that you're using there, when the truth is that at 60, 65 or whatever, 70, whenever it is that you might retire, that you're actually pulling the money out. I think that's, based on what you've just said, still probably leading to a higher risk or higher equity allocation than most people would counsel.
I think the two fund, if you pick the key is knowing what it is and picking the date correctly, where I do think you're right that it would be presumptuous. Most people retire and roll it over. Yeah, but that would apply to every single fund and every single 401k then, right?
But still,
like they've got to, from the fund company's perspective, they can't predict what date you're going to take your money out, so they got to use one of these assumptions.
True, but this isn't an asset class commentary. This is a portfolio composition commentary. And so, in that sense, yes, the fund might go, might be rolled out or cash. It might be sold and money rolled over into something else. But I think it's the portfolio composition philosophy that's really the question here.
And for me, the question is knowing what the glide path is, and if you're picking one of these funds, selecting the right date. Because I would assume that naturally, if you're picking this fund, you're going to say, well, I'm going to retire in 2040. Let me pick the 2040 fund. And that's what I think the individual does if they're picking these target date funds. They're lining it up with a retirement date. And if they did that for a to retirement glide path, it would have been completely the wrong decision.
Well, I agree with that. So, here I guess is we've done a dive into this glide path, but I just want to say the big differences here to be aware of are as you sort of examine what your target date retirement fund provider in your workplace-based finance or retirement plan, what their philosophy is, you want to look and see whether they have an extremely gradual decline out of equities and that they maintain a fairly high equity allocation even during the transition period, or whether they're one of those that drops somewhat more, or whether there's a sharp drop on the last 5 years with the expectation that will then reverse and grow higher. You might say, Erik, how am I going to figure that out? Well, here's a way. You can look and compare at the underlying equity and bond allocations within not only the nearest future date, but also look at a couple of the previous already past dates. And for example, you might say, I'm going to compare the 2025 fund with the 2020 and the 2015 fund, the 2010 fund, all of which may still exist within your fund offerings. And you can see if they have, in the 2010 and the 2015, a higher equity allocation again than is true in the 2025 fund. It's a good bet that the philosophy they're using is that, as at least as I defined it earlier, the to and through, which creates a rebound in the equity allocation as time goes on.
And I think you can just like I when I looked this up earlier, I think if you put in the fund's name and type in glide path, it's actually relatively easy to find what they're doing as well. Because they tend to tell you if you on their website, so it's not too hard to find. I just find that the interesting thing to me is this was supposed to simplify everything, and it seems to have almost done the opposite. Let me move us on to the last item we have. Our counsel. What would someone comes into your office, they're talking to you about these funds, Erik, give me the short response. What would you tell them to do?
Well, the fact that they're sitting in my office means that they're probably someone who's looking for advice. And so I would say, let's look at the options within your existing retirement plan offerings and see whether or not it's feasible to design something that's more tailored for you and better diversified, and that has a stronger lineup of funds overall than is possible to obtain that using the single target date retirement fund. On the other hand, if you're not in my office, but you're listening to this podcast and you don't have an advisor and you don't intend on having an advisor, at least not for the foreseeable future, then in your case, unless you personally have a strong inclination to do a lot of this research yourself, then I would say in your case, even if you may not have the optimal version, I'd rather see you invested in a target date retirement fund in your plan than using the usual fund selection approach that I've seen people tend to use, which is what's worked best over the last 5 years. I'm just going to pick the 3 or 4 funds that have all worked best over the last 5 years, and that's going to be my portfolio. Yeah, that's probably going to be then that it's all bundled up in whatever asset class has really worked best recently, as opposed to having a genuinely diversified portfolio that will be robust. And that counsel that I just gave to you, if you're not going to be using an advisor, is even more important to heed if you are in fact getting closer to retirement, because pick the 5 strongest funds or 10 strongest funds or whatever your number is within the plan, I think is a much worse way of building a portfolio than the target retirement date fund approach. Now, that's my advice. How about you?
I would agree with that completely. The first thing that you had said that stood out was if someone comes to you, you would try to build a portfolio for them.
Mm-hmm.
And I can't think of many instances aside from someone starting a 401k up where I've looked at any of these target date funds at all. Right. So that I would line up. The second thing I would say is kind of like you said, it's better than methods people have used before. So I do think it's an improvement overall. But at the very least, I think you've got to try to do a quick Google search to figure out what glide path they're using to at least get you to pick the right target date for you, just because that can be so different. And at the very beginning, you had said how they aren't all built the same. What's with this glide path issue, a fund that has almost the same name, like Fund Family X Target Date 2050, can be totally different investments.
Mm-hmm.
And you wouldn't think that by the title
Mm-hmm.
or by the name of the fund.
Right.
So we always say this, do a little bit of research if you're doing it on your own. I think we could stamp that as a broken record in all of our episodes and add that there.
Mm-hmm.
Adrian, welcome back. I know you had an internet hit. We were just talking about our counsel to people that are not coming in to meet with us and are considering the target date funds. Would you have anything to add?
Yeah, of course. Just again, look to see how well diversified you are. Again, one of the features where people think about target date funds, kind of just set it and forget it. I just kind of peel back the layer a little bit and see how well diversified you are. Kind of look at your goals and your needs, obviously, just to see if you need to make any adjustments along the way, just to kind of see just if you're going from like aggressive to conservative, just kind of look at the glide path there and just see if it's going to fit your overall financial plan. I think is really important. Like you said, just do your homework and do your research. There's a lot of these target funds out there, and if you are a person that's set it, forget it, that's great. But if you are someone that like to do like the research, there are like we said, a lot of options out there for you to kind of express what you kind of need for your overall plan.
Yep, and you can. I've looked at this. It's actually a really quick Google search. I've tried it with multiple fund families just to see. So I think you can find your answer in definitely less than 5 minutes, maybe in 2 or 3. You also, if you are still listening this deep in, you know that we are available to help. Please call, email, contact us on social media. We are happy to help. And if it's unrelated to this, you've got show ideas, we'd love to hear those as well.
Listener questions.
Yeah, we've had episodes built on those before, and we'd be happy to do another one.
Yeah. Also point people, listeners, we've said it, but if this is the first episode you've heard in a while, don't forget to visit our website, which is now up and running, which is www.retirementlifestyleshow.com. You'll find all our past episodes, all the show notes. You'll find the YouTube versions, the audio only versions. It's awesome. You can subscribe and you can reach out to us. So it's all in one place now.
Yeah, and wherever you listen to podcasts, like, subscribe, tell your friends and family about us, send links out. We would love the support. And thank you for joining us. We'll be back next week. This has been another episode of the Retirement Lifestyle Show.